Well, good afternoon and welcome to today's SVDX webinar. My name is Nancy Easterbrook. I'm Executive Director of Silicon Valley Directors Exchange. We're delighted to have you join us today for our session covering the SVB failure, lessons learned, or perhaps not. Today's session will be 1 hour in length. We will be recording it. And as always, please submit your questions via the Q&A feature on Zoom. It's truly my pleasure to introduce our panel for today. I will do very brief introductions and then we will begin today's webinar. Anat Admati is the George G.C. Parker Professor of Finance and Economics at Stanford Graduate School of Business and a Senior Fellow at Stanford Institute for Economic Policy Research. Her disciplinary interests lie in the intersection of business, law, and policy, and specifically governance and accountability mechanisms in the private sector and in government. An updated edition of her book, which I highly recommend, The Banker's New Clothes: What's Wrong with Banking and What to Do About It, was just published in January 2024. Teresa Bazemore joined Federal Home Loan Bank San Francisco as President and Chief Executive Officer in 2021. She is a seasoned leader with more than 25 years of executive experience building and leading both mortgage insurance and services businesses. Ms. Bazemore also serves on the board of directors of T. Rowe Price Funds and First Industrial Realty Trust. Our moderator for today, Dan Siciliano, is a successful technology CEO founder and entrepreneur and recognized expert in corporate strategy and governance. He is chair of the board of the Federal Home Loan Bank San Francisco and currently chairman of SVDX, board member of the Latino Corporate Directors Education Foundation, chair of the Council of Federal Home Loan Banks, and a fellow at Stanford University. Thank you again for joining us today. Special thanks to Teresa, Anat, and Dan, and I will pass it off to you, Dan.
Great. Thanks very much, Nancy, and welcome, Teresa and Anat. Welcome back, I think, in both cases. We've had you on before at different times. So today's webinar is not intended to rehash the Silicon Valley Bank failure, though however tempting that is, nor necessarily to dig too deep into the minutia of banking complexities. But what we do hope to do, and we'll inevitably touch on both the things I just mentioned, what we do hope to do is really understand what lessons boards can take from what happened at Silicon Valley Bank. And so in a very large, broad sense, I want to kind of kick off the questions and encourage people to also type in questions. We'll get to them as we can. I want to kick off the questions by asking each of you in turn to give us, if you had one observation about the critical mistake, the thing that Silicon Valley Bank board should have done differently, sooner, faster, not at all, whatever it is, if there was one thing you had to point to, and then we can list others. I know there's many, but what's the one thing you wish they had done or not done or hurried up about or slowed down about, if there's anything you would have pointed out as a takeaway? So whoever wants to go first is fine. I'll cold call on Anat unless Teresa wants to go first. But Anat, are you willing to take a stab at that? Okay.
So the lesson is clearly for the board that you have to understand the business model and understand the risks, and that auditor sign-off is not enough, because that was the way accounting rules played out. And in that case, it's even a regulated institution, and even the regulator's blessing, none of those were really enough to say that the bank was okay. And so that's the main lesson, is that, you have certain watchdogs, but they are not really reliable.
Great. And we're going to come back to that as a theme about what you can, abstract from a green light from a regulator and what you shouldn't. And then what's in between then? Like, what are you supposed to do with that? So I like that opening. We'll come back to it. But Teresa, how about you? What's the, one thing that you wish had been done differently by the board or mistake they made?
Yeah, so I think it's also on the risk side of the equation, right? And I think it's important to understand how the environment is changing, what's happening that could affect the institution. So in this particular case, right, when you go back and look at the contrast between how fast money can move between the financial crisis, which was really more of a credit situation, and this situation where, well, what happens if all of a sudden, you know, because of social media or whatever, there's this huge movement of money, how is the institution set up to deal with those kinds of risks? What happens if interest rates go up much higher than what is, you know, normally sort of expected? How is the institution set up to address those risks? And I think sort of looking out and not just thinking that you understand all of the risks that are out there, because I think everyone, or at least hopefully everyone now, has enterprise risk management, but knowing that those risks do change over time and understanding how the institution is thinking about them, I think is an important role for each of the board members.
I want to add a little something, if I can. So the risk that you first talked about was sort of one of those banking type of risk, this liquidity risk that all these people come for their money. You know, it is special to banks, but it's not the main risk here, because the reason that people came for their money is because of risks that can happen to any company. It's just in the banking, it will last longer. And when it manifests itself, because these people, the depositors, have demandable type of debt, they can run when they want to be sure to not lose. In other contexts, you might not get to that position, but the problem of whether you can pay your debt is there all the time. So this solvency risk is true for all companies. It just manifests itself sometimes with a liquidity type of run in banking. And the reason that it then happens fast is because in this case, the bank hid its insolvency for quite a while, and what happened was just that people were becoming aware of it. So sometimes, you know, insolvencies can remain dormant if the money is not due yet, but so there's no default quite, but the fear of default, you know, would be something that creditors will begin to signal, and, you know, might end up leading to a normal company filing for bankruptcy. In the case of the bank, you know, regulators closing it down.
So
Yeah,
this is interesting. Oh, sorry.
No, I was just going to say, I think that really is the crux of it, right? Because in a lot of companies, there are other things you can do. There's time you can, you know, you can pull this out. You can do bankruptcy. You know, when you're talking about depositors coming in and many of them being able to do it in their on their mobile devices, it's just that risk becomes a different type of risk in terms of how quickly it can sort of unravel.
Yeah, and I like the point, though, which is the event that killed the bank effectively, which is the run, is more the symptom of a whole set of dysfunctions, in the same way that a heart attack is what might kill you, right? A massive heart attack. But there was a lot that led up to that, right? There was a lot that, you know, it wasn't the heart attack per se. There was the high blood pressure, the arterial sclerosis, the uncontrolled, like, and you know, in this case, though, the one difference is that the final killing act is manifest when people realize all these other things are actually present and there. Is that a fair restatement, Anat? Because I want to try to generalize that to, like, what should boards do therefore? So
the failure of Silicon Valley Bank was kind of the largest since Washington Mutual. Now, what happened in Washington Mutual back in 2007-8 was, you know, it wasn't like a fast run like this, because this was before social media and even, you know, as much mobile banking. But it was a slow run. It was an on and off run, and but it was kind of, so it was happening over a longer period of time, but it was the same economics. It's just this, the only difference was really the speed with which things happened for Silicon Valley Bank. But, you know, Washington Mutual was also became insolvent, and depositors were beginning to run and then stopping for a while, coming back to run. And it was a little more like lines outside the bank, like the old days, like in the movies. But I don't want, I think to Dan's point and your agreement too, that, you know, we cannot focus on the social media part of it, because that again is a symptom. It was just the way Iran happens these days, as opposed to, but it's the same underlying economics.
And let me kind of try to abstract that. So one of the things you've both said, and I just want to expand it, is if you're on a board, you should know your industry. This is so obvious and such a low bar that I think everyone listening is like, well, obviously. But I think built into that is something a little bit more subtle, which is you need to understand what's changing in your industry, what the dynamics, what the rate of change for your industry is, and how that might play out. And so in this case, the run is maybe not the thing to pay attention to, but the notion that the capacity of a digitally social media enabled run was something that happened at, I think it would be no exaggeration to say about 250x the velocity of like a WAMU type run. That is a different world. Now, what leads up to it is very similar, but once that starts, there is nothing a board could probably do at all.
Well, and I think, when you think about what's continuing to change, right? So if you go back to that scenario, right, we had a cutoff at the end of the day, right? So $42 billion came out during the course of the day. There was another 100 billion or so that was, ready to come out the next day. There's a reason why they were taken over on a Friday morning, right? And so when
Which, just to explain to those who don't follow this closely, a Friday morning is unusual for a takeover. You normally wait till the end of the day. Yeah.
Right. But as we get to things like 24/7 ability to move money, I do think it changes the risk profile. It doesn't change the things that, we'll talk about with respect to what should boards have been paying attention to prior to that time. But death can come more instantaneously. I think that's part of,
But
once people realize the issue.
Sure,
Then
Anat, go ahead.
I want to go back to your statement that was sort of obvious, know your industry. And I want to go back to an example, not from banking. They're very much a Silicon Valley example. Theranos. Did the board of Theranos know its business? So I mean, the thing here is going to be, to be skeptical of what people tell you. And that includes even the auditors and the regulators. In the case of Theranos, it was the CEO and what she's telling you, or FTX, which didn't even have a board. These are just very, more recent example where the CEO was the center of it, but it's sort of a theme throughout in terms of, the industry, the risk. It's obvious, and yet we see it failing right here, people handing out enormous checks to FTX and not asking questions.
It becomes more, I was just going to say, it becomes more complex as these organizations become more complex, right? So when so if someone, has a company that is fairly focused, right? The board members should understand that business. But what happens when you look at some of the financial institutions or other companies, it's not just financial institutions that have many, many different lines of business? Is it really reasonable to think that any one board member is going to really understand this when they're not even their management that doesn't understand each one of those businesses? They may understand one or two of them at a time. And so how do you populate the board as well to try to cover off on sort of the group understanding the business and the risks and knowing how to ask the right questions?
I mean, I want to expand on that by reminding us when we were discussing this earlier, one of the kind of snarky but truthful answers about, well, as a board member, what would you do? And one of the answers was something like go back in time and not join a bank board, right? Like, to your point now, that sounds almost untenable for a board member to be able to manage a very large, the complexity of governing a very large bank. And so with that in mind, I wonder, like, what other items do you think are a best practice among board members that might have made a difference in the Silicon Valley story, so that we can kind of abstract that as a lesson? So Teresa, I'll turn to you first. I know you've served on several boards, both financial and non-financial. Like what would be, it doesn't even have to be obvious, a best practice that you think if it had been more manifest on the board, maybe it would have made a difference?
Well, certainly, I believe that it's really important to have a strong chief audit executive and a strong CRO at the institution. And I think they have to have reporting lines to the board, to the appropriate committees. I think they have to be engaged in leadership at the organization so that they know what's going on and that they feel confident in raising issues and concerns, not only with leadership, but with the board. And so, you know, I always look at that in terms of, is that the culture of the board? And does the leadership of the organization embrace it? I mean, as a leader, I always say to the chief audit executive, I want you to tell me if you see a problem so that we can work on fixing it. I don't want to hear about it later or from someone else, right? And so I think that's part of it in terms of, is there a culture that really looks at understanding the risks, managing the risks, putting the right people and expertise in place? And so that's one of the things that I always think about.
And I think you implied this, you know, without saying it, but the facts for the Silicon Valley Bank story are not great in this regard, right? So there was an absence of a chief risk officer for a period of time. It's not clear how much power the chief audit executive had. So there were some weaknesses that maybe if they had not been present, some of this or all of it could have been avoided. I want to ask a follow-up question, and Anat, you should feel free to answer also on this follow-up question. And that is to remind us the audit function best and standard practices are pretty clear. So you have an audit committee, you have a chair of an audit committee, you've got robust independence throughout that. They have a direct line to the chief audit executive, internal audit head, and that can circumvent the CEO, like it has its own independence, and that makes sense. So that's important in light of what you said, but I do want to tease out integrated or a part of leadership. That's an interesting, there's no requirement about that. And there are sometimes very isolated chief audit executives who are kind of outside looking in. They have the right to look in and talk about it, but that's a different feel. That's cultural. I like that point. But tell me about the chief risk officer in particular. It is my general understanding that the CRO role, first of all, depends on what kind of business line that people are in, whether they have a CRO, but banking, obviously. The CRO doesn't enjoy quite the same autonomy or connectedness or reporting lines in most organizations as a chief audit executive would, in part because it's not regulated or required. But by that, I mean the head of your risk committee, who's a board member and has a connected dot at least with that CRO, they don't have the same like independent autonomy that the chief audit executive would have with the chair of audit. Sometimes CROs don't even report to the CEO. They might, you know, report somewhere else. So can you comment on that? If you are in a financial or highly regulated insurance industry, for example, should you be paying attention to the CRO and try to elevate those best practices as a board?
Absolutely. Absolutely. First of all, I think you should be understanding too how your CEO is, you know, bringing the CRO in and how they're balancing those issues in terms of risk and, you know, in bringing income in and making sure there's some balance there.
Mm-hmm.
But also, I mean, I think, and we certainly do this and other companies do too, there's usually a risk committee or a credit committee, certainly within the financial services world of the board. And in that context, the CRO, in fact, can work with the board directly. And I would argue should have an executive session with the board where the CEO isn't present. So that there is an opportunity. So while it might not be a regulatory requirement, the board can in fact structure things so that there is enough of responsibility, autonomy for the CRO in terms of communicating with the board and raising any issues.
Anat, what do you think about that?
I want to make a distinction. You kind of lump them together between sort of risk and chief risk officer and how you handle risk, because risk is forward-looking. Risk is understanding what can happen and how likely certain outcomes will be, and especially downside risk. I mean, upside, you know, we like it. And auditing. So auditing is often kind of more of a you know, backward-looking exercise. It's a more static exercise. Risk is more about, you know, looking into the future. So there are kind of different types of things. So when you say, you know, that the risk is, you know, So for example, the description of Michael Lewis in The Big Short, was like how risk officers were just, and in other books on the culture of banking, the risk managers are kind of party spoilers, and they're like getting low status in the organization and not a lot of access and not a lot of voice. Now, audit is sort of, now you get into accounting function, auditors, external auditors and the internal auditors. And now it's a question of what is being revealed about the situation, about the reality of the financial structure and the types of assets and liabilities and all this stuff, and profits and risks and payouts and all this stuff. And then the question there is, so the question on risk is sort of what's the true risk, what can happen and how likely it is to happen, where are we on of that. And when you get to audit, it's like, okay, what truly is, so now it's more about sort of facts and truth and what some people don't want you to see about the situation. So this sort of hiding of losses, or hiding of the ability to pay, any of those kinds of things are more in the, so auditing is more of a check of a box checking exercise. It shouldn't be. In other words, an auditor should, in principle, warn about, liquidity risk, solvency risk, all of that. So there's that connection over there. But for that, the auditor internally and externally shouldn't just be box checking, because then you do have to get into the risk assessment. And that's a much more complicated exercise than box checking by accounting rules or something else.
Let me ask a question where those two things come together, and that is stress testing. So stress testing is a term of art in the financial services world, but it's also something that other industrial sectors engage in, even if they don't think of it as a regulatory exercise. And that is scenario analysis, downside risk analysis, upside opportunity. Okay. So in the stress testing, I was struck when I started spending more time in the financial services world that stress testing, at least is directed by the board. I'm not talking about, as instituted by regulators, doesn't typically in financial services do what you would do in an engineering environment, which is you stress until breakage, right? Like you want to see where everything breaks. Instead, you make a set of assumptions and say, oh, if interest rates went up this much, or if we had a shock that reduced liquidity by this, how bad would it be? Which that seems like a useful question, but it doesn't seem like the important question, which is at what point do we actually break? And that's kind of so could you comment on that? Because I think it has applications to other industrial sectors, which is, okay, we know these 4 things affect us. Can you tell me how far would have to go and in what combinations, at which point in time we would be in extreme distress and maybe fail? And so why not stress to failure as a lesson for what to do and not to do? Or maybe I misunderstand what really happens under the hood. Anat, do you want to go? And then maybe.
Yeah, sure. I mean, so stress testing, the question is, okay, so you can, a stress scenario is, first of all, I mean, it has to be, interesting enough, and there could be many scenarios. So, I mean, again, it's like checking one scenario doesn't make sense, because lots of things are possible. That's number one. But number two, and the most important thing is, what is it that you are actually the bottom line of this? Is it some kind of a regulatory capital or accounting, book equity, or what is it that you're saying will give you confidence or will be good enough? In other words, what is going to, be the thing that stays or survives versus the thing that fails? And the problem here, it has to do with the workings of markets, because a lot of times what really, you have to predict is what markets will do, as opposed to what some accounting disclosure will do. In other words, you can put it into a black box and out will come some number, and you'll say, oh, I'm capitalized, in this scenario and that scenario, but that's maybe because the capital ratios or metrics are completely uninformative, which they are. And so the problem, and that's a problem also with regulatory testing, it's a complete charade the way it's done, because a lot of the time you cannot at all anticipate, or you do not actually in the stress test anticipate or know how to model the precise market reactions to the scenario that you're imagining. So you're saying, oh, XYZ will happen, unemployment, whatever it is. Now you have to translate that through some black box into some other number. How trustworthy is this exercise? So, there's a lot of modeling involved in a stress testing in this environment. It's not an engineering thing. In an engineering thing, you can just, if you have an actual physical model of something, and then,
you
it
can
breaks,
bend it
that's
until it
a
breaks.
physical,
Sure.
of a physical thing. But we're talking financial markets, say, or,
Right.
issues around, solvency or financial health or scenarios, for stakeholders. That involves how markets would react to all kinds of financial markets and other markets.
So I'll come back to that, but Teresa, what would you have to add to that?
I would just say that I think, there are questions about how you do these stress tests. Do you do them to breakage? How far do you go in terms of assumptions? But at the end of the day, part of it is then what do you do with the output? And at what point do you decide that you have to do something different than what you're doing in the organization? And I think that is the really difficult part of this, right? There's certain things that are certainly standard practices, best practices, et cetera. And you should always be thinking about what are those and are we doing those? We've sort of talked a lot about liquidity risk, but there are tons of other, the OCC's talked about 8 different types of risks. We could talk about reputational risk. We could talk about operational risk, which could also have a huge negative effect on an organization. But at the end of the day, the question becomes, when in this sort of scenario of what could break the institution, what are the signals that you're also looking for to see, hey, I think I might be going into this scenario. What do I do? Do I pivot? Do I change how I'm operating? That becomes, I think, a much more difficult judgment call. During the financial crisis, we started a lot of companies, and we certainly did at my old company. We started doing scenario planning, right? Trying to figure out what were the things that could have the biggest effect on our ability to do business going forward. And then what were those scenarios? And then trying to decide what was the most likely scenario, what was the next, because each of those might cause you to take different steps in terms of how you were operating the business. And then, how do you find the signals or determine what those signals are that are giving you some view that you're moving from one scenario to another that might cause you to change how you're operating.
I want to add something.
Go ahead.
That is, when you talk about stress to break down, certainly in the context of, financial health, in the sense of, are you able to absorb losses, things of that sort. Once you actually can absorb losses, you can be a little bit more relaxed about the risk because they won't break you. So there is no reason in this context of a financial kind of risk or risk of insolvency or bankruptcy or takeover by regulators to live dangerously. There is no risk. My entire book is about how you can actually have buffers that, many of the companies that venture capitalists fund have, because they don't borrow at all. Now, in a bank, you don't live like that because your life starts with debt in the form of deposits. The problem is that the economics of corporate leverage is that leverage is very addictive. And when you're a bank, it's particularly addictive because you have a bunch of creditors called depositors who do not have a collateral and don't have covenants and only have pretty lame regulators protecting them. And at that point, you can give some more assets as collateral, including to the Federal Home Loan Bank and other lenders, and basically the depositors are not even aware, just that they are being put at risk, because actually it's the FDIC's risk that's going on here. And so if the FDIC is either thinking that, whatever, they're going to have to charge the other banks, or, the Fed will come in, or whatever else, then nobody's paying attention to these risks. So that's the reason that banking is particularly prone to terrible governance conflicts. Other sectors, the markets are working a little bit better than they are in banking. I mean, in banking, the regulators could step in and fix the market failures, but they're not good at it, which is sort of a shame.
I want to ask two follow-ups that's going to land us on a point that was raised in one of the questions that was posted that has to do with board dissent by a small number of people on a board and how you act around that and how that plays out. But let me set it up by going back to the stress test. And again, I appreciate what you said, Anat, but in some cases, even with the complexity of the market, you could set up a Monte Carlo simulation with like 25 different variables, and you could map out, let's assume that a board has the time to interpret this, which is Teresa's point. I think it's a real challenge, but you could map out the cases in which things fail. And at the very least, in the case of Silicon Valley Bank, you could have asked a series of staged questions. What if interest rates go up 100 basis points in 2 quarters and then double again? What would that mean, right? So, and that would be, you'd have a probability distribution, but it would at least force the board, arguably, to say, hey, this part over here, what's that mean? Oh, we're technically insolvent. Oh, what's the probability of being technically, what would happen then? And so these kinds of conversations, what stands between, the board and having more of those conversations, and not just in banking. You could ask, what happens if exchange rates alter in terms of our overall balance of sales internationally? What happens if, overall rates go up and so our revolving, credit becomes much more expensive? There's a lot of things that non-banking institutions also could do with that. And maybe Teresa, start with you. What is it that prevents boards from engaging with management around those? Because those have strategic implications, or maybe great boards do that, and I'm not observing that. But what stops something more technically analytical like that instead of just these more simplistic stress tests?
Well, I think for one thing, it's very complex, right? So sometimes board members may not feel as comfortable, although I think they should feel comfortable asking questions. I think sometimes board members get comfortable with kind of management, and they think, that whatever they're hearing is fine, and they're not asking the probing questions or questioning whether what they're hearing makes sense. And so I think that's another piece of it. It's also one of the reasons why I think you want to refresh the board, because, we're talking about the landscape changing, the risks are changing, et cetera. And I think you want to have people come in maybe with a fresh eye who, are willing to ask those questions. But I do think, you see boards where, everyone sort of just listens to they're being told, and they're not sort of they're not questioning whether that's right. I also am a big proponent of training, right? Whether it's reading the materials that are coming from some of the audit firms, or, other things in your industry where you can learn about, or what new governance practices there are. I think that also helps board members understand what some of those issues are, or some of those risks are, and how they should be thinking about them and asking the right questions in the context of understanding the risks at those organizations.
I'd like to point out that neither Anat nor I pushed the director education line here, but Teresa brought it up, so I appreciate that. Anat, I want to maybe have you contribute to that answer, but narrow in a little bit more even, and that is part of what you were getting at before about which variables, what to look at, is the salient risk analysis, right? So this, if you read the reports around Silicon Valley Bank, this comes up obviously, but what regulators might look at may or may not be salient. And in fact, probably were not in this case. So the regulators form patterns and habits that are dictated by the past and are modestly refined over time. And so inevitably they're going to miss a lot of the emerging factors, so they don't hit the salient. A great board, it feels like, should be better equipped to Teresa's point, perhaps a refreshed, renewed board, to identify the salient risks, identify the salient opportunities, right, which may not be the story, and move forward. So not in banking, or broaden, if you'd like, what constitutes a high functioning board such that they help management identify and spend time on the salient issues as opposed to the rote issues, the check the boxes, the backward looking stuff that the regulator's bugging you about maybe?
So one of the things to realize in banking is that the regulators are not always asking the right questions, but the problem in banking fundamentally is that many boards and bank shareholders for whom the board might think they're sort of supposedly trying to serve, are potentially in conflict with the FDIC or with society. And, so it's not clear that a board would do that. In fact, in banking, you might consider that that an independent board member would be representing, I don't know, the FDIC and so sometimes the regulators, they're supposed to pay attention to the governance. I would have liked to see an actual routine engagement with somebody who truly is independent, but also potentially from from the shareholders and from the board member and from the managers. In other words, from everybody involved, to the extent that they are regulated sector, that means that somehow, regulators, so nominally working on behalf of society, have a reason to be involved because of the privileges of the bank. So that's special to banking. I would not say that you need a member of the public in every board. In some boards, obviously, in other countries, and we think it's completely unusual and weird, but it's actually not clearly so. You do have a representative of. It's not any kind of majority, a representative of other parts of the organization, like co-determination in Germany or whatever. And it's just, sometimes it's enough that one person actually asks a question, for example, about compliance issues. So we didn't get to compliance, but there's just a book, a paper I just printed it to read. I still like to read on paper, on Caremark, which is presumably what a lot of boards know about, and that is the duty to comply with laws. Consider, I don't know, I've mentioned already cases of fraud, but think of consumer fraud like Wells Fargo. Whatever happened in Wells Fargo, and how did that board get to the point where if years of consumer fraud happened and they somehow were not doing anything about it until it became a huge scandal, and then have to, commission a report and take up big ads and try to recover, trust in the bank. How did that work out? And how was it working out before that they were opening, 8 accounts miraculously for every customer or seeking to do that? Where was the board of Wells Fargo, one wonders. And then, there was I remember, you might remember then, in the Harvard blog, I think it was Howell Jackson who said, throw the bums out, and they still were maintaining their board positions.
Right,
so,
right. So let me back up and parse that. First of all, I love how you so casually in a easygoing, chatty fashion pulled the pin out of the grenade and rolled it into the governance world and said, maybe we should have some sort of really independent outsider representing the FDIC show up on a bank board. Like it's such an interesting proposal. I just want to call attention to it because it highlights something, which is shareholder alignment at any given moment, arguably, and improvement in the share price and maximizing their profits, particularly in banking, may or may not line up with the public interest and may or may not line up with the shareholders' true long-run interest, right?
Because there are depositors and borrowers and all of that.
Yeah. So there's it's complex in banking, but it's a nice segue to this other question, which is whether or not you set it up deliberately. Yours would be interesting, right? It's a kind of permutation on the, any number of international board strategies, but let's just assume that you've done a good job of putting together a board of truly diverse thinkers who I don't want to go down the rabbit hole of stakeholder versus shareholder, but let's assume they have a broad view of shareholder interest now and the future. So really, they're looking at everything. And out of that, you have, maybe it's an 11-member board, so big-ish. You have 2 or 3 people who, when they're given this Monte Carlo simulation that we talked about, right, hard to interpret, they all but panic. So the board as a whole reflects and says, oh, that's not so bad. And there's like, wait, there's a 5% chance that we end up completely insolvent. And you have a small group on the board who have a specific articulated concern that is not irrational. It is supported by data, but reasonable people can disagree, right? So they think 5% is too risky for an end of story risk. Others don't think that. What does a board do? Like what should that group do? What should a board do? I don't think we know. I don't think we know if there was any story even like that at Silicon Valley Bank. But if there had been, what would have been the thing for that cohort of the board to do? So I'm channeling a version of a question that we got a few minutes ago. Anat, why don't you go first? And then Teresa, I'd love you to add on, because I think there's a lot of practical issues here. Not that Anat can't address those, but I think there's some deep theoretical and then some practical issues. So Anat, how about you go first?
So, I come at it from just like a common sense perspective in terms of governance, and in terms of sort of truth and who's impacted. So say there's a risk that, stakeholders are impacted. Imagine you're on the board. I mean, again, I'm taking examples from recent news. You're on the board of Boeing. Someplace in the organization, the decision was made to tell the Federal Aviation Authority, FAA, that, we don't need to train pilots for this 737 MAX, okay? Now, I don't know what a board member can or can't know, but if you're a board member of Boeing in this situation, say, and there is whatever X% chance that, not just you go insolvent, people die, okay? In a preventable way, that you just wanted to save money to compete with Airbus or whatever, if that's the kind of thing you're doing, which ultimately becomes a fraud against the FAA and a criminal, penalty and all of that, deferred prosecution, but whatever, then, I value the whistleblowers. I actually think, it's the moral duty, if not the civic duty, of anybody to both ask questions, and then if they don't like how other people want to avoid it, to actually speak up. Now, most people won't do that who are working within the corporation, but this takes us to the issue of whistleblowers. So I think in general, corporations should really promote whistleblowing, potentially anonymously, and that the law should protect whistleblower very vigorously, because you want to know the truth. And so I think, this avoidance of unpleasant facts is a problem in many settings of society. And I think, if we talk about corporate governance, board, which is like the government of the corporation, should not be looking away from truth about the corporation, whether it's going to harm, customers and ultimately the shareholders when they have to pay the fine and take up the ads, or have derivative suit or securities fraud suit or whatever, and feel at least bad, if not truly get in trouble.
So on the one hand, the industrial sectors you picked have certain elements, either a deep public interest component or a systemic component, or in one case, a kind of a common carrier feel to it in terms of, responsibility. So I think that does distinguish it. But it's interesting, this idea of a whistleblowing attitude potentially on the board. Now we have methods for noisy withdrawal. We have some close proxies to kind of whistleblowing for board members so that they don't end up simultaneously blowing their fiduciary duties and trying to do the right thing. But I like that. I don't approve or disapprove, but that's 2 grenades in 12 minutes. So that's pretty good. But let me let's hold that
I'm a
thinking, and then I
troublemaker.
want Teresa to comment on like the practicalities of that. So that's one path to go, which is pretty extreme. If you're the 1 or 2 or 3 dissenting directors who are like, we can't do this because of these things, you know, how to handle it. Are there other experiences or strategies you've identified, Teresa, as a best practice for a board that is arguably not stuck, right? If it's only 3 out of 11 directors, they're going to move on, right? They're going to vote, they're going to, you know, move past it.
Well, I think it sort of gets back to a little bit of what I was talking about earlier, which is to sort of really understand what are the things that could create the circumstances where you're getting to that 5% as you sort of defined it. And what should we be looking for, and what should we monitor, and what are we going to ask management to keep us posted on? So that's how I would sort of be thinking about it. If I'm in the majority and not the, you know, the sort of dissenting 3, sort of making sure, hey, you know, there's a point here. What should we be focused on? What should we be monitoring going forward to understand that? You know, just to mention, sort of to tack on to what Anat was saying, this is to me where you also focus on operational risk. I think boards maybe sometimes don't focus enough on operational risks because those can have a huge impact, whether it's a Boeing situation or whether it's something that creates a reputational risk. And I always look at it in, you know, in the Wells Fargo case that Anat was referencing, if it's too good to be true, you should be asking some questions about it. You know, when the rest of the industry was trying to figure out how Wells Fargo was so successful at cross-selling, and no one else could figure out how to be so successful at cross-selling, maybe the board should have wondered, why are we so good at this when no one else can be? And at least have some plausible reason why that is. But it also helps you think about, well, what's the culture? Because I think once all of us saw the situation where accounts were being opened without the permission of the customer, then you started to see other things that were happening in the organization. And that becomes a question of, is there a culture issue? And often boards don't necessarily think about culture. And do you have a culture that is focused on trying to do the right thing and trying to also make sure there's a balance in terms of how risks are being addressed in the organization? And it's not just about how much money can you make or how much, you know, you can best, you know, do better than your competitor, because your competitor may do better, but something may take them down later, right? That if you managed it better and you can withstand whatever those issues are.
So let me unpack some of that, because that had a lot in it. So first, I think embedded in what both of you said is the notion that if a board is disagreeing, it might be prudent to really deeply assess. This takes time, and that's always a challenge with boards these days, I think, but deeply assess if you're really operating from the same facts or you just have different beliefs. So do you know what you think you know, and do you have disagreement when you all agree that what you know is the same, or is there something more complicated going on? Like, oh gosh, I just don't believe that that's how it'll pan out. Well, then dig into that. So I throw that out there because that's almost a board process issue, and it's a shame to disagree when you are operating from different facts. Like that's kind of a wasted time. So, but then embedded in that is this focus on operations, culture, and process. It's a little reminiscent of what people call the Bluebell case, but it's the Marchand case. Like the idea that if there is a core feature or a core set of risks or a core kind of the saliency around the operations of what you do, it is prudent for the board to ascertain if the operations are sufficiently effective and comprehensive and have the right feedback loops to actually be sure you're doing the things that you know are most important. And I know that's, again, a little bit obvious, but I think it's really good. And you differentiated between operations, culture, which is, it's you know, supplemental and augmenting to that, and then process, which is maybe more about the board, where all that feeds back up. So that was a lot. And I think there are some just universal best practices from that. So maybe, you know, we want to switch to a couple other questions. We've gotten a few. I want to encourage people to put some out there. We've covered a lot of ground. I want to go back to just maybe some differences in boards. And I think we got a question that maps to this, and that is around this culture and risk-taking operations. Are there elements of boards? There are observable differences in boards. It can be, you know, across different countries, the UK, Canada, US, like the question that was just posed, or maybe it's just something you've observed where boards get this stuff better. So what kind of a board is better at assessing and leading culture? What kind of a board is better at paying attention to operations? Is there anything that we can have a takeaway? And feel free to compare and contrast internationally. And I know both of you actually pay a lot of attention international, and Anat, you've done so for some time as well.
Yeah, I mean, I don't have like empirical, you know, evidence scientific, so it's a lot anecdotal and common sense. But, you know, my general view of what I've seen is a lot of time just, you know, boards going along with things. So I'm big on asking questions, and I'm big on digging into things. And so, you know, to my common sense, you know, different people on the board can be kind of experts in digging into certain things and pay attention and be a little skeptical sometimes, and just you know, talk to other people in the organizations. I mean, again, the question is how, you know, long people spend. Is it just the board meeting and the reading materials, or is it anything else that you do? Because you actually can do a little bit more, you know, looking around and talking to people and getting
Right.
your real sense for yourself of what's going on. And so, you know, I just like the notion of people really applying their own common sense and not being easily placated and daring to kind of ask questions. I mean, I know of a case of a board member of I think it was called INA, or an Italian energy company, and you know, they were involved in, you know, corruption in Africa, and you know, the many people on the board, from the perspective of the one board member I talked to, just really just preferred not to look, because, you know, it was going to challenge the management, and they didn't feel like doing that and all of that. And the board member who wanted to talk about it felt pretty isolated, and then ended up, I think, leaving the board. So what ends up happening is you kind of have only, you know, the people who wouldn't challenge be on the board. And I think you have to watch for that. Too much groupthink and too much
Yeah, if you have departures, you have a survivorship bias.
In the discussion we had earlier, I even brought up the really jarring situation that happened during my lifetime at Stanford Business School, which is the fact that an ex-dean of the Stanford Business School, but not just any ex-dean, an accounting professor, was the chair of the audit committee of Enron. And you know, that was many years ago in the life of probably many people, you know, in this webinar, but, you know, it was over 20 years ago or 25 years ago. And, you know, it was a very complicated company with a lot of, you know, obviously, you know, subsidiaries and then related entity transactions and all kinds of shenanigans on the accounting. And Arthur Andersen was in bed with them and all of that. And here's the chair of the audit committee claiming that the board, I mean, he's a good person and an honorable person, and he claims that the board was in the dark. So a board should not be in the dark. I mean, that's just like basic stuff. A board is there to know things. So will they only know what they're told? Do they do any more digging? That's really a fundamental question to keep in mind. You hear what people choose to tell you. And maybe there's things they don't want to tell you. I think being skeptical is a good practice in general. If you dare to ask, you know.
Sure. Yeah.
You can expect an answer.
And whether board members or, you know, have the willingness
right
and the capacity, right, to really learn about the business and, you know, try to understand the issues, because as the world gets more complex, right? If you're talking about international businesses where the rules are different, if you're talking about corporations where they have very different businesses that they're doing, it requires board members who are really willing to spend more time and roll up their sleeves. You know, there's that concept of not being overboarded, right? And I think that's come up more and more because as companies become more complex, or as the risk world becomes more complex, it becomes important that board members are willing to sort of ask sometimes difficult questions that maybe management doesn't like, but there should be that's what they're there for. And there should be an expectation that board members are going to, in fact, ask some of those difficult questions.
And I'll let you each kind of round out some comments here in just a second. We received some questions in the chat section, so I didn't see them until just now. But one question was, does anyone have any sympathetic thoughts or excuses for the Silicon Valley Bank board? And I think we covered that, which is, the speed at which this happened. Certainly there's responsibility for, what happened, but the speed at which it happened, once it was underway, there's nothing a board can do once you had that run underway. And we talked about the fact that it's the things that came before that are the responsibility. I would ask one question though, and if we can keep the answer short, and then we can do the final comment. So any board that is in place when something in a highly regulated complex industry grows 3 to 5x in a very short period of time, so grows more than it grew in the prior entire existence of its entity, almost by definition, it falls into the too good to be true issue. That kind of growth seems almost inevitably to create extraordinary challenges. That's maybe not an excuse for that board, but it's sort of a warning for everybody. Is there anything you would do differently if you were on a board that was growing so quickly? Is that what would be the step you take, realizing you're on a rocket ship that inevitably is going to have something become manifest as a big problem? Teresa?
Well, I guess for me, I'd really want to understand what are the dynamics? What is it about the product or process or service that we're offering in in that company that is causing this to happen? And what are the risks that we're taking on that maybe we didn't have before? Maybe they're risks that we had, but now they're much larger. And what are we putting in place to try to manage and control those risks and understand them? So those are the types of questions that I think are the right questions to ask. And
it's a sort of, oh, sorry, go ahead and finish your thought.
Sorry. No, I was just going to say, when we're talking about SVB, right? The question we'll never know the answer to is if they've done some of the right things prior to when they had that loss the day before. If it had been much smaller, would we have seen the same outcome?
Right. Anat, you get final comment. One takeaway that you hope in like 30 seconds or less that people will not forget or will act on now or will do something about. It can be in only banking or it can be broader if you like. And then same for you, Teresa.
I mean, if you grow as much, you had to say you grow very much by borrowing, because they grew by obtaining, a flood of deposits. Okay, so that's very dangerous, because if you put that money to risk and you didn't adequately put equity as well, that's what can happen.
Sure.
Whether the fact that it happened fast was again because people just took time to wake up to the situation more than anything. But really, the lesson is just getting fooled by accounting, getting fooled by assurances that are not valid. That's, I think, a lesson that goes way beyond this situation, certainly here. And the entire perspective of the regulators also about the focus on credit risk, the avoidance of interest rate risk in the entire framework is crazy in banking as it is elsewhere. So, and the risks often kind of would come on both sides of the balance sheet at the same time. So some of it is special to banking, but the notion of being fooled or lulled into thinking that risks are not there that are there is probably a lesson for all boards all over the place.
I appreciate that. And finally, Teresa, last word, 30 seconds. You get
I
to-
would go back to my director education and say, understand what those risks are that are in your industry, and then sort of use that as a critical eye to asking the questions, not just relying on what's put in front of you.
Great. Well, this is great. We're out of time. I appreciate the conversation so much. Thanks for everyone for taking the time with us. Anat and Teresa, thank you for being our experts today. We appreciate it very much, and we'll see you probably again soon enough, and certainly those who attended. Thanks. Have a great day.
Thanks. It was
Thank
great
you.
to be here.
Bye.